So how does rich people pay no taxes? So in this video, I'm going to go through this piece of paper with you on normal people paying taxes, normal people paying less taxes, and how rich people pay no taxes. And I'm also going to go through OpenAI ChatGPT to verify some of the flaws in this meme as well. And I'll include this meme in the video. So let's get started. So let's talk about normal people. Me and you, people who are getting a salary. And let's say you get $1 million in salary, which sounds fantastic, right? It makes you an instant millionaire. So you pay 40% in income tax, and afterwards you get to keep 600,000. So a significant percentage actually goes to income tax. So how can we do this better? $1 million worth of company stocks. Now, at this point, if you need to use the cash, your money is locked in the stock, so you can sell the stock, which pays a 25% capital gain tax, so then you keep 750K. Now, depending on whether or not you're in Canada or US, this number might be slightly different, but 25% is a good reference point. And finally, no tax. So you get $1 million in company stocks, you use it as collateral to borrow money from the bank, and he spends the borrowed money like his income. So legally, he actually hasn't sold any stock, which doesn't trigger capital gain tax based on the act. And then the debt is not treated as real income, and on paper he has no income. So then his stocks continue to appreciate, which is actually important. If it doesn't appreciate, then he's screwed. And he only pays capital gain taxes if and when he sells his assets. And that's actually one of Elon Musk's strategy on why he pays so little in taxes. Now, as tax rules are complex and there are a few inaccuracies with this viral meme. So let's go through them together. So the first one is that you getting $1 million in company stocks, the kind of company actually matters. So if you work in Coca-Cola, a public company, and you get paid $1 million in stocks from them, that gets taxed immediately, even if it is a restricted share unit, RSU. So you are actually paying the same amount of tax, ordinary income, if you're receiving $1 million in stock, and that will force you to sell the stock, let's say on day one. Now, if you're receiving stock from a private company shares, which has resale restrictions, you can actually delay the income tax recognition until a liquidity event. And that usually means IPO or some other event. But then that also means you might not be able to borrow against it because it's not public, and banks don't really do borrowing on private shares. Now, on the other hand, for this 1 million company stocks, you don't need to actually get the stocks. Instead, you can choose stock options. And this is slightly different because for stock option is the right to own shares of the company. And that's actually a lot of executives or board of directors will get is the stock option. So then if the stock price increase, let's say from $5 to $10, they will pocket that difference from $5 to $10. And when the option is being awarded, if it is at the market price for the strike price, so let's say the stock today is $5 and you're awarded option with a strike of $5, there's no income tax. And then if you exercise, you can hold on to it, and then you can enjoy the lower long-term capital gain tax rates in the US. So then this becomes tricky because you're not really getting $1 million of company stock without tax. And if you are, then you will need to pay tax when it is available, meaning it's no longer restricted or vested. So then you're still paying the 40% income tax. That means in order for you to execute this strategy, you actually need to use stock options at the fair market value, and then the stock needs to appreciate. So let's say you get $1 million in stock options at $5. So then once the stock appreciate, let's say $2, you exercise, which means you need to pay strike $5 to get the shares, and then you're holding on to it, which will then incur capital gain if you sell it, and you don't sell it, and then you can borrow against it. And the company needs to be public. So this strategy is actually quite difficult to execute if you're working for a private company, which a lot of us are. And if it is a public company, you need to use stock options instead of shares. Shares, you still get tax. Now, another interesting thing that this viral meme brought up is actually the ability to borrow against your portfolio. So that allows you to significantly reduce your tax, and it's very similar to the concept of refinancing in real estate. And it goes like this. In real estate, people buy real estate properties, and the properties go up in value, and let's say they need cash. What do? They don't sell the property. They go to the bank and they refinance it at 5%, 6% or whatnot. They take out the cash and use it to buy more properties. So then what becomes important is the amount of down payment or equity you have within the property versus the amount of debt or mortgage you have in the property. So let me give you an example. Let's say you purchase a real estate property for $1 million. You put 20% down, which is $200,000. And after 3 to 5 years, it's gone up to $1.5 million. So let's say you don't even bother paying down the mortgage. That means the equity you have within the house is the $500K gain plus the $200K down payment you have. And then you have an $800K mortgage. So then at this point, you can refinance and you take out as much money as you can, such that you only have 20% down again, which is $300,000. So then you're taking out $400,000. So after a couple of years, you took out $400,000, and now you're free to use this $400,000 without paying any capital gains tax to buy another property. Or you can use, let's say, $50K of that for living expenses, and then you can use it to buy more investments. And that's really how the real estate wealth building game works, is through series of refinancing. So the capital gain then does not become realized until many, many years later because it doesn't get triggered until you sell the property. Now, a similar thing can be done with stocks. So let's say you have $1 million in portfolio in Microsoft. And instead of selling Microsoft and you take the proceeds and you live off it, you just take a collateral loan, let's say $50,000 against Microsoft, and you continue to hold $1 million worth of shares. So you just go to your account, your brokerage account, withdraw $50,000 without selling any Microsoft stocks. And you can only do this in a margin account. So then the Microsoft stock will continue to appreciate. Let's say it goes up 20% this year. You make an additional $200,000. Technically, you need to pay capital gains on it, but you don't because you never sell the stock, and you take out another, let's say, $100,000. So then your margin loan becomes $150,000 now, because the first year you took 50 and now you took out 100, and you're paying interest on it, let's say 6%, 7%, but then Microsoft is growing at a much faster pace. So then your wealth continues to grow, you're not triggering any capital gains, and you're just enjoying the growth of your portfolio without capital gains. And that's how it would work. So this meme, it's a bit inaccurate in the sense where when you receive the $1 million in salary versus in stock, you're getting taxed because it is shares, unless it is an option. Once you invested and you borrow against the shares, that's when you can avoid the tax. So that's really the secret, which is actually the same strategy people use in real estate and refinancing their mortgage to a higher and higher amount. Now, another interesting observation you might have is really the depreciation of money. Now, this is actually a very important concept that I realized in, let's say, the last 3 years or so, which is kind of odd given that I have a master's degree in accounting and I study economics. I'm an investor and chartered investment manager. But let's say you bought a house, you have a mortgage of $800,000. Okay, seems like a lot. And a natural thing for someone to do is to be debt-free, which makes sense, less stress, and you want to pay down that mortgage, $800K ASAP. That is a very emotional response. But if you think about the value of money, 800K today versus 800K in 10 years. If the real estate market is growing by, let's say, 7% a year, that means in 10 years, the value of real estate would double, and the money you borrowed actually depreciates in value as well. So you paying 800K today is worth a lot more and costs a lot more to you than paying 800K in 10 years. In fact, mathematically, paying 800K in 10 years will feel like you're just paying 400K because the depreciation of money would basically half your purchasing power. So whatever you buy in 10 years with 800K will be a lot less than what you can buy with 800K today. And that's why when you look back in the last 10 or 20 years, a house, instead of $1 million, might only cost 500K or even 200K if you look back 20 years. And this is really true in Vancouver, where I'm living at the moment, is that a house or even a townhouse back in the day, 20 years ago, was only 200, 300,000, and now it's like $1 million, $2 million. So if I take you back in time 20 years ago, and you see that there's a house, 200,000, okay? You put 20% down, that's 40K, 160K mortgage. And you kept that mortgage. You don't pay it off, just keep it, just pay the interest. And over time, the house becomes more and more valuable to where it is today, which is around 2 million. And obviously, there's a lot of equity gain. Congratulations. But what's more important is you kept the mortgage of 160K. So back then, 160K will seem like a lot, 20 years ago. But 160K today, that's just a regular engineer 1 to 2 years worth of salary. So then you can see how 160K today can't even help you buy a house. But back then you could. So if you kept the mortgage and the economy continues to inflate, hence inflation, then the value of that money goes down. So that means paying off that mortgage in the future, let's say 10 years from now, will be a lot more beneficial than paying it off today. And that brings you back to the idea on why they're borrowing against the asset. It brings you back to the idea on why real estate investors always like refinancing. And it brings you back to the idea why Elon Musk takes out loans against his Tesla shares instead of selling it. And if you understand that, which then brings you to using leverage to increase your gains, that's how people get rich and paying no taxes. So in the recent months, China has released an AI model called Deepseek. And it shocked the Western world because the cost of running the model is extremely low. And basically, it allows people to run large language models, LLM, on their own computer. So when it comes to investing in China or any international market, you need to understand the nature of how they do business there and the business strategy behind these companies. And that will give you a great understanding on how you can interpret certain news events. So that's what this part of the video is about. So let's get started. So in the last 3-4 years, I've been working in China, Hong Kong, Shanghai, Beijing, basically in the major tier 1 cities in China as an M&A professional. So my background is CPA, and I'm also an M&A advisor for some of the largest private equity funds in China. Now, when it comes to China, it is very interesting. Now, compared to US, where innovation is very bottom up, in China is much more centralized, and these large tech companies will try to have a small investment in many tech companies. So then you can imagine there's a web coming up from the top, let's say 5 tech companies into all these smaller tech companies. So in a sense, they don't want to take on too much risk where they own the entire tech, but instead they want to have a stake in a lot of different tech companies to diversify and basically lower their risk as much as possible. Now, when it comes to technology, it's a strategic initiative in China, meaning that China will fund specific technology for them to be competitive within the country and also in the world. And they're willing to lose money for as long as possible to achieve market dominance. And there are a couple of very good examples. One example is Xiaomi. So Xiaomi is a technology company that makes cell phones really cheap, and basically they copy or mimic a lot of technology from, let's say, Apple in US onto their phones, and they distribute in China. So basically, where their income is much lower, they want to distribute to as many people in China and overseas as well. So they want to get that market dominance. Now, the problem is that this technology can cost quite a bit of money, and they're willing to operate at a loss to do so. And that's because it is their mission to bring that foreign technology, let's say developed by the US, to the Chinese people. So the company itself is public, is losing money, but is funded by the states partly as well, so that they are able to launch all these products and increase the quality of life in China by offering technology at very, very cheap cost. Now, the second industry or example we can look at is the EV market. So if you have been investing, you probably heard of the Chinese competitors for EV, which includes BYD, Li, LI, which is public in US, NIO, NIO, and they're all concentrated in China. And because the market is so competitive, the EVs actually cost very little money in China, which allows for mass adoption. So they might be selling cars at a loss, but they'll want to capture that market share, so do it as cheaply as possible and as efficiently as possible. So you can imagine if you're being funded by the state, which is China, and your strategy is to lose money initially such that you achieve market dominance 5 to 10 years later, then you realize that the price you see, the cost of buying an EV might be, let's say, 20, 30,000 US dollars, is not reflective of the true cost. And this is an important point, which I'll bring you back later when we're talking about Deepseek. Now, if the Chinese EVs end up going into the US market, and the US market right now is positioned as like a premium EV market where all the EVs are more expensive than regular gas car at this moment, it will completely crush the US auto manufacturing scene for EVs, just like how the Japanese with the Hondas and the Toyotas crushed the American automotive market back in the day. So you can do a little bit of digging, but basically a similar situation is happening between Japanese cars and the US automotive market, and now the China EVs with the US automotive market. But obviously there's a bunch of tariffs and a lot of other policy in place which stops the Chinese cars from coming into US at this moment as I'm recording this video. Now the third example, which is actually quite interesting and only makes sense if you're in China, is transportation network. And this is really based on my past experience as an M&A advisor. So there's a couple of large transportation network similar to how Amazon Prime delivers the goods to you very quickly. They have their own version of that as well. And these transportation networks will try to operate and cover the entire China, even if it is not profitable. And it is well known in China that these companies will capture as much market share as possible, price their shipping costs very low such that they can drive out competition. And for years, these transportation networks lose money. But it's important because they want to connect the entire China and offer that service to the people in China. So now you have 3 concrete examples on how to do business in China, mostly, and the business strategy to achieve market dominance. So that brings you back to AI. Now, right now, the US strategy for AI is really to develop a more and more premium AI model. And then if you look at OpenAI, there are subscriptions, and more premium subscription for OpenAI, especially for the latest model. And eventually, you want to reach AGI, which is artificial general intelligence. And that is supposed to be the best model or even have intelligence greater than PhD level students or professors. So now Deepseek in the last couple of months comes in, release a model that achieved maybe 80 to 90% of what the GPT-4 version of the model. So it's not the latest model, but maybe 2 or 3 versions older, and at a much lower cost. And they claim that they only use $5 million instead of something like a $500 million budget. Now, what's interesting is that if you actually follow this company and you look at some of the interviews, you'll find a CEO, Alexandra, I think his name, said that they have 50,000 GPUs that they acquired through indirect means to train this model. Now, obviously, because there's a US sanction, they actually cannot disclose the exact number of GPUs they have. So then the cost is not going to be reflective of what the true cost is to create this model and then making it available to people. So there's a couple of considerations here. So the first one is the stock market in US panicked and NVIDIA dropped around 16 to 17% within one day. Now, a normal investor would think and go like, oh my God, this is really bad and I need to sell NVIDIA now. But if you look a little bit deeper and you do research, then you realize that the China team is also in the AI race. And they're going to be wanting to beat these premium AIs. And by doing so, with an kind of like a semiconductor sanction, they're going to release open source, free model to beat the premium version. So they can get mass adoption. And if you just pause at this moment and think about it, this is actually the exact same strategy for EV with very low cost cars, even at a loss. Exact same strategy as the transportation network. And that's actually how they do business in China. And by making it free and getting the mass adoption, they can later on charge things or run advertisement to generate a profit. So the key is to achieve some sort of monopoly on a global scale with their AI models. So whether or not they charge you a certain price, it might be subsidized by the country itself. So then they can achieve market dominance. And this strategy has actually worked quite well for them, given the amount of adoption, the transportation network, solar panels, and also other initiatives that China deems important, and AI is going to be one of them. So that means going forward, if Deepseek continues to release new models and serves a larger population, they are going to come back and they're going to need more GPUs from NVIDIA. Now, whether or not they can buy directly from NVIDIA with or without sanction, that's going to be a whole different issue, or they acquire it through some indirect means. That's going to be something they need to figure out. And there are many creative ways to get these GPUs from different markets, not directly from NVIDIA. So that means if the AI race is on between the two countries, which is US and China, then the demand for these GPUs will continue to rise. And hence, you don't need to panic sell NVIDIA when it dropped on Monday during that weekend where Deepseek was suddenly the #1 store on the App Store. So when you're investing in different companies, you really need to take a step back and understand what are really the driving forces behind the countries. Sometimes you look at certain data points, there's potential subsidy and additional motive in terms of strategic initiatives for certain countries that can come into play, which changes the cost structure. So then, if I am a US AI company, I'll be quite concerned. And my goal is actually to get to AGI as quickly as possible. And I need to raise more capital to do so. Now, the interesting thing about this is that whether or not China can continue to operate at such a low cost to build their AGI. And that's going to be an interesting question, because if you look at the 50,000 GPUs held by Deepseek's team, that's already 250 million. So you don't know how they count their costs, first of all. And second, it's much easier to look at something that's already done, let's say GPT-4, reverse engineer it and create a cheaper version and slash more efficient version with a lower budget, than to go from GPT-4 to the next model, which is O1, O3, and O4. So if China needs to catch up and create O4, I don't think they can do it with less GPUs. I don't think they can do it with less money per se, because you need to experiment. It's a lot easier if I show you the path and I tell you, hey, this is what an electric car should look like, and you just copy it and copy my homework, versus I tell you to create the future of transportation and you need to come up with that in your own mind. That's going to require a lot more experimentation, and that's why innovation is so expensive. So in terms of whether or not the AI fundraising, the amount of capital that is being poured into AI at the moment is justifiable, that can be slightly inflated, but nevertheless, this endeavor, it's going to cost a lot of money, simply because of the experimentation involved to figuring out how to do something. So I think that is really the key. So if China is going to join the race and they need to be as fast as US to get to AGI, then they need to invest just as much, if not more, into CapEx, which is the central question all the news articles trying to raise, whether US should put that much money into AI. Because if you need to be at the frontier and develop the next model, which is right now is O3, so if you need to develop O4 with the current GPU and technology you have, you need to spend that R&D. And you can be 10 or 20% more efficient, but you're not going to be 90% more efficient than another country. That's why I think the demand for NVIDIA will continue to stay, which means it is actually a good buying opportunity on Monday. So since then, the market has bounced back a bit. So as a long-term investor, I have a very technology-focused portfolio, and I continue to hold. And basically, I'm going to continue to observe and see what the Federal Reserve decision is and what this next earnings season will bring. So that's kind of more important. And since then, today is Tuesday, the market has already bounced back quite significantly. So when it comes to investing, let's say you have some cash on the side, it is important that you take advantage of these opportunities. So when the market is at a high, you don't need to exit everything you have. You just need to exit like a portion of it. Think of it like Warren Buffett. He always has some sort of war chest in cash, such that when he sees a good deal, he buys it. And that's kind of what you want to do.